governing documents of the entity. And we'll briefly touch on some capitalization issues and things that you need to do to maintain the limited liability of your corporation or LLC. And as I'm going through this, if you have any questions, feel free to. So this morning, we're just going to quickly run through some slides here on corporate formation. I'll talk about the three main kinds of entities, and then taxation. You'd be surprised at how often tax considerations will drive the type of entity that you're going to select for your business. And then investors. Do you have outside investors at the start? Are you self-funding this? Will you be bringing in investors later? Are you going to seek venture capital? Do you eventually want to do an IPO? These are all things to be thinking about right at the outset. And then also your exit strategy. Is your plan to the three main types of entities here? The corporation, as you know, it's owned by stockholders, governed by a board of directors, and managed by with the state. You're going to have a set of bylaws that really outline how the corporation is governed. And then if it's a small company, as most start in the state of California, and an operating agreement, which serves the same function as the bylaws and stockholders agreement do for a corporation. It really sets out how the LLC is governed. Those are owned by partners, governed by a general partner. Two kinds of partnerships are the general partnership and a limited partnership. Are not often used, or I would say I've never seen one used in an operating business, particularly a startup. Partnerships are generally used for investment funds, things like private equity, and there are some real complications in the tax code that drive those investment funds to choose partnerships. But suffice to say that they're really on their equity investment. They're going to want a liquidation preference. All those things are possible if you have a preferred class of stock, which would be different from the basic common stock that sort of the founders would have. The C corporation's also always a C corporation. The big disadvantage of a C corporation and the reason why a lot of startups are not initially formed as C corporations has to do with tax issues. The C corporation is subject to what's referred to as double taxation, meaning corporation is sort of reported on their own personal tax return. So you really avoid that double taxation problem with the C corporation. The disadvantages that there are limitations on the number and type of stockholders that an S corporation can have. You can only have at most 25% share in an S corporation. You're going to be allocated 25% of the income and receive 25% of the distributions. Now, the limited liability company is by far and all of the members, like a stockholder in an S corporation, they receive a K-1, and the income of the LLC is reported on their personal tax return. And unlike the S corporation, you can have different classes and types of equity interests. You can really tailor a class of equity that is preferred stock with a distribution preference, meaning that the money investors will be repaid first of any returns. You can also offer profits interests, which is will give the member of the LLC a share of the LLC. This is common for incentivizing employees. The equivalent to the preferred class of equity in an LLC with preferred returns would be preferred, and a profits interest, could equate to an option that's issued by a C corporation. Typically, those we either could convert to common stock that's restricted, in other words, subject to vesting requirements over a period of time. But the process for the state, it sort of makes sense given the advantages of an LLC and the flex. It's often advisable to start out as an LLC and then later convert if needed. Yeah.
Well, when you do an LLC, is there a flow through of liabilities as well? The liabilities of the company flow through to the shareholder?
Well, there is a flow, directors and key officers, as well as its agent for service process. The new company is going to apply for an employer ID number. That's basically your tax ID number that you get from the IRS. 2 months of incorporation. You're going to have subscription agreements for any investors that you are bringing in at the formation. You're going to set up a corporate minute book and stock ledger. Now, an LLC, on the other hand, the documents are fairly similar, different names, but you have an Articles of Organization that's filed with the California Secretary of State. If you decide to document, it's basically a one-page document that just lists your name, your purpose.
In the beginning, you've started a company, you have got a little bit of your own money into it, maybe some friends and family, you've heard about that. And you want to bring people to help you. And everyone has heard of options. Well, what are options worth? This is the very beginning. In the beginning, the worth of stock options. Does anybody know what an option is worth?
Zero.
Well, they're worth a little bit more than zero, but we can't put a dollar number on it, can we? Otherwise, nobody would accept an option. At the end, what are stock options worth? This is the Black-Scholes formula. Now, when do you, and the Black-Scholes formula is a famous formula developed by 3 economists to value stock options. But it only works when there's a large active trading market in your options, okay? So in the beginning, this is you. What I hope for you through the magic of entrepreneurship is that you end up where you have to use the Black-Scholes formula to value your options. That means you're public and very successful. So I want you to memorize that formula and work it out before you do your next step.
Can you just run through it for us?
Exactly. Okay, the stock options is the most available currency. You hear the word currency, you think of money or dollars. And that's what's most available to you. You can issue stock. And you can issue as much stock as you want, as long as people will accept it. Of course, you can always inflate the value of the currency, right, or deflate the value by inflating the number of options. Is it the most expensive currency? Perhaps, but it's the most available currency. We'll talk about that. Why do you want to use stock options? Well, you need to attract talented people, and you don't have cash to pay them. So you pay them with stock options. Now, you want to attract talented board members. To be successful, perhaps one of the keys is the right people on your board. The right people on your board can open doors, give you great suggestions, find people to help you out. I'm a true believer in having excellent people on your board. In fact, a superstar on your board, if you can get it. Superstar is somebody whose name people know in the industry. So most excellent board members will not pay attention to a startup unless they believe in both the prospects and they get a piece of the action, so to speak. You want to attract excellent consultants, and you want to attract excellent employees. Now, an excellent consultant would be an attorney, for example. It might be a CFO. It might be an engineer. These are people who, in the market, get paid $200,000, $300,000, $400,000, $500,000 a year because they're that good, but you don't have the cash to pay them. So what else can you pay them with? Well, perhaps stock options. If they believe in your company, perhaps they will work for you, provide consulting services to you. Now, you can't put them on the payroll full time because there's not enough for them to do. But a day a month, a day a week, whatever it takes, consultants will sometimes work for less cash and some stock if they really believe in what you do. The third one is to attract excellent employees. And you need employees to be committed. Now, what kind of employees do you want to attract with stock options? Not somebody who works 40 hours a week. You want somebody to work how many hours a week? Come on, tell me, how many hours a week? 80 or 100? Well, you know, 100, that's a bit much. 80, that's a heck of a lot. That's Goldman Sachs type work. But nevertheless, I would say you want to attract people who are going to work 50 to maybe 80 hours a week, somewhere in that range. 50 on the low end, 60 to 70 hours. You want them motivated enough so that they're working that many hours. That's a lot of hours. I hope they still have a family life and social life. They should be able to integrate it. 50 hours a week is not that much. 60 hours, you know, starts pushing it. But you want them to work hard, and the way to do that is motivate them with stock options. Why board members? I've mentioned this before. The success of your company will often depend on the quality of board members. Well, how much should a superstar board member get? I think that a superstar board member, remember, one who is famous in the field, people will give you instant credibility. That might be worth 5% of the company or more because of the doors that they can open. So don't be niggardly in terms of giving out your stock options to the people who can really help you out. Why consultants? I mentioned these before. You don't have enough money to pay them, put them on staff at the going rate. So you use stock options to help them out. And we talked about the 50, I'm getting ahead of myself here, how hard they should work. How do I value stock options? Well, in a startup, it's impossible to set a precise value. It must be negotiated. When you're negotiating, it's often just your gut feel. But there are a few touchstones we can talk about to help you get some feel for value. You compare the value of options with foregone salary and with foregone opportunities. Everybody has an alternative to use his or her time. So how do you want to motivate that person to use that person's time for you? And that's one reason we do it. Once I have the value parameters, how many options do I grant? Well, let's just run through a little scenario. You rationally calculate the value of your company in 5 years. Now, that means you have to set the assumptions that you use rationally and logically, and usually they're much lower than the entrepreneurs want to talk about. So you rationally calculate the value of the company in 5 years. What could you actually do? 5 years will be hopefully your exit, right? You're going to sell it, merge it, or take it public. That used to be the paradigm, and going public is not so much of a paradigm anymore, but merging or acquisition is an exit strategy. Rationally assess the risk profile. The earlier the option grant, the greater the risk. It is just like money. The earlier the money, the greater the risk, and therefore the greater the return. You have to look at how much additional capital would be required, because remember, each time there's a round of investment, you issue more stock, and the number of shares expands, and therefore the percentage interest in the company is diluted. What will the cap table look like in 5 years? You have to look out that far, and therefore you should have somebody who knows how to run a spreadsheet. And what will the per share value look like in 5 years? After you look at that, then you determine a rate of return for the risk profile. Some ventures are very risky, some are not so risky. You have to assess your risk profile, and then you do a present value calculation to determine the number of options to be granted. As you look at that future value, discount it back to present value based on your rate of return, figure out what you should grant at that particular moment in time. So let's take a look at an example. An employee is worth $100,000 in the market if you paid the employee just cash, but will work for $50,000 plus options. That means that that employee is investing $50,000 in your company. Assume that this company is pre-Series A funding, I mean very early, and since it's a pre-Series A funding, The rate of return that somebody wants to get out of this early investment is, say, 15 times the investment, okay? VCs want what, 10 times the money? You often hear that. So this is even pre-Series A, so you want 15 times your investment. So 15 times 50,000 is 750,000. That's what this employee should want to get in 5 years because of the risk. So target the value of your company in 5 years as $75 million. Now I'm assuming it's going to be a very successful company, okay? So I'm talking to those of you who are going to make it big because your employees are working 60 and 70 hours a week, and so are you. So the employee needs 1% of the company to achieve his target of $750,000 at the end of 5 years. Assume that there are 15 million shares outstanding at the end of 5 years, $5 a share. And so you need to grant options on 150,000 shares at the outset to allow that person to achieve his 15 times investment, or 750,000. Now this sounds very logical. I'm not sure how many people actually go through these steps, but it gives you a conceptual framework to figure out what to grant. Yes?
Why did you choose 15 million shares? Like, how do you determine how many million shares to have in total?
Well, if you get investors who invest, venture capital firms or private equity firms, they will invest at a certain dollar per share, and they are going to value the company. Now, do you want to take your company public at $5 a share, or $10 a share, or $15 a share? I put it at 5. If you wanted to take your company public at $10 a share, then you might adjust your cap table to, instead of having 15 million shares outstanding, 7.5 million shares outstanding. But if a venture capitalist invests, say, at 50 cents a share, and that investment wants 10 times return, the shares are worth $5. So it can be any number, but so you pick your target value that you think you can achieve, and then say, how many shares will it take me to get there? And I have to price them out. Now you can sell shares at any price you want, 50 cents, $1, $1.50. These are just some numbers that are easy to remember, but they could be $1, it could be $10, it could be $25. But the same type of math would occur to determine how many options to give out to a particular employee. Now, let's look at an example of a later stage company where the risk is much less. The employee is worth $100,000, but will work for $75,000 plus options. So he's investing, or she is investing $25,000 equivalent investment. It's a post-Series D funding. You've been successful to attract 4 rounds of investment, and now the risk is much lower. You can see a path to exit. You've got market traction. You've got sales. It's increasing quite rapidly. And so how much return in 5 years should you get on a post-Series D funding? Well, perhaps 2 times return. You double your money in 5 years, and so that is a return of what? Is that a 20% return, something like that? And that might be the proper return for a late-stage funding. Once again, the value of the company is $75 million in 5 years. To achieve the target of a $100,000 return, let's see, I did my math wrong, didn't I? Oh, dear. Well, let's say it works for $50,000 and invest $50,000, then the math works. So, but it's late stage, and so it's much more certain that he will get it. In that case, he would need, or she would need, 0.1333% of the company to achieve that target. Once again, 15 million shares outstanding, $5 a share, options on 20,000 shares. So take my 75 up there and put 50, and he's investing 50, and then you've got the same math. So the early stage versus late stage all depends on the risk profile and what the return needs to be to attract somebody. Okay, issues of stock option. If you are an employee and a startup company offers you options, then what questions do you want to ask so that you get the value? And of course, if you are the entrepreneur hiring somebody, you need to understand this as well. You need to know the fully diluted cap table. That means at the time the option might be exercised, what will the cap table look like? How many common shares outstanding? How many options outstanding? How many warrants outstanding? How many convertible preferred outstanding? You sort of do a fully converted, fully diluted cap table to see what it looks like. You need to anticipate your future earnings. That is, can you really grow to 75 million in sales or in value? And then based on those numbers, you can calculate the other numbers. How big is this typical stock pool? Well, 15 to 20% is sort of a rule of thumb that new companies will set aside to attract the proper talent to work with the company. The value of stock options is very much affected by the terms of the other classes of shares. If you have 4 rounds of investment, Series A, B, C, and D, all of those are likely to be preferred shares, each one with a priority over the earlier round, and they might be convertible into stock at a certain price. They might be just a straight preferred that has a preferred dividend attached, but otherwise just like common stock. You need to know what is there, because if you've got a Series A preferred, that allows a conversion at a 2 times the price or some other number. It can greatly affect the dilution. So to really value your stock options, you need to know the terms of the outstanding shares. Now, are there contractual traps? Entrepreneurs, I've seen some entrepreneurs who want to assure themselves non-dilutable shares. They want to maintain their 25% forever. It never works. It's just a big trap, and you might really fail to be funded if you want to do that. But I occasionally see anti-dilution clauses for some shareholders, meaning that their percentage interest always remains the same, which means all dilution hits the other shareholder class. Buybacks. If you have options, does your option contract allow the company to buy you back at a certain price? That's not very good. It limits the upside. Anti-compete clauses. You have an option, you've worked for several years, some of it's vested, but you want to go work for a competitor because you're offered a better deal. What happens to your options? Is there a buyback clause that prevents your upside? So those are sophisticated issues that people need to look into. Vesting. Typically, an option will vest over 5 years, but it doesn't have to. It can vest at any number of years. So, for example, if you hire a consultant to do a very important job for you, and that consultant completes the job in 6 months, 12 months, 15 months, that consultant will probably insist on full vesting of any options he gets because he's delivered the value. When the employee delivers the value, then they should vest. That's one way to look at it. For employees, you want them to stick around for a while, so it's 5 years. Perhaps no vesting until the first year, and thereafter it vests on a monthly basis. And if the employee stops or quits or is fired, then the vesting stops, and all of the options are canceled that haven't yet vested. If there's a non-compete, you say if you compete, your vested shares will simply be worth 0 or we'll buy them back. Now, by the way, in California, we have a pretty strict non-compete law, and so it's hard to enforce anti-competition laws, anti-competition clauses. So if you can do that in California, you should really look at consult with an attorney. Acceleration of vesting. If you're so successful that the company is sold within 3 years, but yet you have a 5-year option, you probably want accelerated vesting because you've achieved the goal, right? You've achieved an exit that's worth a whole lot. So look at whether you have an acceleration of vesting if there's a merger or acquisition, if you go public, or if you achieve some other definable objectives. Now, cashless exercise. Lots of employees like this. Say your stock is worth $3 a share at the time you grant the option, and you grant somebody options on 50,000 shares. That means that person has to come up with $150,000 to exercise those options. Not many employees will have that kind of cash. But if the shares have increased to $6 from $3 and they had 50,000 options, then he's got $150,000 of equity in there. So if you have a cashless exercise, you can take the equity that's built up in the options and convert that into stock. That's called cashless exercise, so you don't come out of pocket. You might end up with only half the number of shares that you had options on, but you're not out of pocket any cash. So cashless exercise is a big benefit for many employees. Now, options are usually on common stock. That means that they are subordinate to debt and to preferred stock. So the debt gets paid off, and the preferred stock gets paid off, and then finally the common stock gets paid. That's why it's important to look at the terms of the common stock and warrants outstanding and debt outstanding to determine what the value of your options might be. Special terms, buyback rights. Can the company buy your stock back even if you've exercised or it's vested? Can they buy it back? There might be a buyback clause that will have a valuation formula attached to it. You look at that. Voting rights, proxies. Some options have proxies attached to them, so if you exercise, you can't vote them. That's all a matter of negotiation. Tax issues, ordinary income, capital gain, current income. Now, usually, if you have an option and you exercise it, if it's a qualified stock option, this is for a corporation, if it's a qualified stock option, and then you exercise and hold the shares for a year or 6 months, then you get capital gain treatment, which is great, because the capital gain tax rate can in some cases be 20 points lower. But most people exercise and sell right away, particularly if there's a liquidity event, such as a merger acquisition or going public. Then it's ordinary income. Now, if you have non-qualified options, that is, the tax code gives these tax benefits to what are called qualified options. You have to meet certain requirements of the tax code. But an option doesn't have to be qualified. So if you get an option, typically if you can't value it, which is the case in startup companies, then the person holding the option will get income at the time it's exercised, because then you can measure the value of that option. So here somebody has just exercised options and spent $100,000 on options, and all of a sudden he has $100,000 of income he has to report on his tax returns, and therefore you might have to pay $30,000 or $40,000 in tax. That's not a very good situation. So options can be very tricky in terms of income. If you got an option and then you had what is called a substantial risk of forfeiture, then sometimes it's not taxable. You have to wait until the restrictions go away. So it's very complicated from a tax point of view. If you are able to value the options in any way, and then you take into account income at the time you got the options, which might be low, then your options themselves become a capital asset and you might get capital gain. And this brings into account Internal Revenue Code Section 83B, if you've heard of that. So consult your tax accountant or tax attorney to make sure you do that right. But it's all very, very complicated, but you have to look at the tax consequences as well. Do stock options work for LLCs? The answer is yes. The tax treatment is a bit different, but options are typically contracts. So any contract that I can write for a corporation, I can also write for an LLC. To do this, you need to have, obviously, a skilled attorney. The LLC ought to issue shares or units. Now, I like LLCs for startup companies. Some people like corporations. I like LLCs. And I actually call the units a membership interest. That's the technical term in the code. I call them shares. Why? Because people understand what shares mean. And I call my managers directors. And it's just easier for me, and I think easier for other people to call them shares and directors. It can be confusing if other people use membership interests and managers, but I like to use shares and directors. If you use the shares, it's easier to keep track of percentage interest, dilution, and so forth. If you do it right, the LLC can give you the same or better tax benefits than can corporate stock options. And that has to do with interplay between capital accounts or not. If you have a zero capital account at the time you get shares or options, there's usually no income. Now, sometimes you can grant LLC interests with no capital account and no tax consequences, not income. And then you don't have to worry about options. And you can still have the same vesting, all the other acts guild. He can give you whatever tax benefits you want. Okay, alternatives to stock options. You don't have to grant stock options to give people an equity interest. A phantom stock is a form of compensation that can be very attractive to people. They get the benefit of the success without owning any of the stock. Owners like that, or founders like that, because they don't have shareholders who are voting and so forth. And the phantom stock, for example, if I grant you phantom stock and there is an exit in 5 years at $5 a share, then I have a contractual obligation to pay you $5 for each of your phantom stock. It's not actually stock in the company, but it's measured by the value of the company. That's why it's called phantom. Now, down here, I have this term SARS. That is not a disease. Here it's stock appreciation rights. And that's almost like phantom stock. As the stock goes up, you tie compensation, incentive compensation, to the rise in value of the shares. You can have profit-based plans, a contract where you will get a bonus, more or less, if the company achieves certain profitability levels. Now, you can have other plans, revenue-based plans, keyed to EBITDA. Who knows what that is, besides all of the mentors around here? Mostly business owners. Earnings before interest, taxes, depreciation, and amortization. It's almost like cash flow, but to determine the true enterprise value of a company, a lot of financial people look at what is called EBITDA, and then they give a multiple to that. So you can have your bonuses or your incentive payments keyed to EBITDA, cash flow. You can key it to top line revenue. Say you want to hire your top salesperson, your VP of sales, and that person, she says, I can achieve this level of sales, and I want to be compensated on how fast I can grow the top line revenue. So you say, okay, and then you write an incentive clause based on top line revenue. Now you might want to do it based on gross profit, not top line revenue, because the board of directors really, they're more interested in maximizing gross profit than in top line revenue, right? So if I'm the director of sales, perhaps I want gross profit as my mark instead of gross top line revenue. And there are other factors that you could tie your incentive to in lieu of phantom stock options. Okay, stock options, the magic. This is the magic. When Apple went public, 300 new millionaires were created because of stock options. Now, I want all of you who are entrepreneurs here to break that record, okay? I want you to find a product and go do it so that when you go public or there's an exit, you've got more than 300 new millionaires. And so good luck in breaking Apple's record. And now you know very little about stock options, perhaps enough in your mind to help you ask the right questions when the time comes. Thank you very much. Now, I'll be happy to take any questions if there are any. For a few minutes, yes, go ahead.
I've read about dynamic equity maybe before, for a founding team before incorporating, based on contributions of cash and time. Have you seen anything where that works, that a dynamic equity based on contributions?
That's a case in every company when 2 or 3 or more people get together to found a company. So, yes, you say pre-formation, you form your LLC or corporation, you've probably been thinking about it for a while beforehand. That's sort of the dynamic equity. So, at that point in time, get together, decide who gets how much. It's just dividing up the initial equity. That's really what dynamic equity is. Now, if you are the main entrepreneur, if it's your idea that's going to drive this, but you need key people, then perhaps you give them some options, and instead of dividing up the equity among the 3 of you, you keep more of it and give them equity, because you're the main guy who has the main idea. So it's a matter of how much you negotiate with your fellow founders before you organize. Does that help? I think that's basically what you're talking about.
Yeah, I think that's it.
Dynamic equity, I haven't really heard that term, but
So it's and they're foregoing, like you said, their opportunity, the opportunity or money somewhere else. So
Right.
you decide a multiplier on what that person is risking,
Right.
based on, and then cash has its own multiplier, it's worth more. So 4 times cash, say, and then so say I put in $10,000 and 100 hours in a month,
Right.
and my co-founders put in 100 hours that month. Then I have 100 hours plus $10,000 times the multipliers that we've decided over the total contributions of 300 hours plus $10,000. So my equity would be higher. They could come in for 10,000.
I see, okay, so even after you form the company, you want an ongoing formula to help divide the equity up depending on what the contributions are. That's a lot like the stock option plans, and so that's, yeah, I've seen that before. So what is your contribution is, whatever your contribution is, you get compensated in equity based on your contribution. We're going to measure that, and so it might be adjusted on a monthly basis or quarterly basis or yearly basis. Yeah, so you can do that. It's a matter of contracts.
It's contract. Okay.
Yes.
At what point in the life of a startup should you consider putting an option pool in place? At the very beginning, after you've hit
Yeah,
its
as
milestone?
soon as you need it, as soon as you need it. So it could be at the very beginning. Now, if you go after professional money, i.e. venture capital money or sophisticated angel money, they're going to make you run through some of these scenarios to figure out how much money you need to.
Go on forever. No, I'm just kidding. But I won't. Okay. Good evening, everyone. And I know that you guys are very hard at work with your ideas, so I hope that everything comes out as planned, and I look forward to seeing what some of those are tomorrow. I'm going to talk about some important things for you as you plan the future of your ideas, and that is incorporation and board governance. Incorporation is important because when we formalize our business, we should be thinking about what that looks like. And creating a corporation is one of the most basic ways that a company can formalize itself. What does it mean to incorporate? Well, the incorporation process is a pretty mechanical and basic process in terms of how it works. You register with the state that you're going to be conducting business in. In this case, we'll talk about California. So you'll register with the California Secretary of State. It's a simple form. You file the Articles of Incorporation, which will contain the most basic information about your corporation, the name, the address for the agent for service of process, the business street address and mailing address. And that form gets filed with the Secretary of State, who issues a California corporation number, and that's your identifying number for your entity. You will then choose or not choose to make what's called an S election, which is the taxing election for your entity, whether you will be subject to double taxation if you are a regular corporation, a C corporation, or whether you will be a closely held corporation of 100 shareholders or less and have chosen to have the tax benefits flow directly to the owners instead of having that double-tiered system. There are some nuances with the S election, so it's important to always seek out the help of a professional. For example, if you are not a citizen or do not have legal status in the United States, you are not eligible generally to be a S election corporation, so you would have to be a C corporation. But there still are opportunities for shareholders who are not legal residents or citizens of the U.S. Then you will register with the Department of Corporations. That lets them know that your security purchase or acquisition was through, viable means, meaning you didn't necessarily go out and seek investors and publicize, because if you did that, there's all of these SEC rules that you would have to follow. So for small companies like yours that you're going to be starting off on, you're going to generally follow the closely held corporation's rules. You're going to have the issuance of stock. You'll get stock certificates, which will have your name, the name of your trust, the name of you and your spouse, whoever the legal owner of that stock is going to be. The next step is you're going to have to appoint your board. And generally, in closely held corporations and small entities, like we have mainly here in our county, especially the ones that are starting off, your board is going to be comprised of your owners. So ideally, a corporation works in 3 systems, 3 tiers. The owners are at the top tier, and they're the ones who obviously have the ownership interest in the entity. Then you have the board of directors. The shareholders appoints the board. And then you have the officers. And generally, the board of directors are the ones who hire and deal with the officers. In a small company, those 3 tiers, although they may be distinct on paper, they are generally the same in terms of they end up being the same individuals. Next, you will have an organizational meeting where you gather your board and you will make decisions concerning where you bank, what kind of contracts you're going to enter into, if you're going to take out any loans, who has what power. So you will define the roles and duties of officers, and you'll impose any limitations that you want. And that's a requirement with the state of California to have an organizational meeting and resulting minutes from that. And continued maintenance. In my opinion, the most important part of a corporation is the continued maintenance, because it can be fairly simple, at least speedy, to be able to set up the corporation initially. And it's the ongoing necessities and the formalities that people often lose sight of. They'll start their corporation, they'll get their book, and then they'll forget about their corporation. Maybe they'll submit the annual statement of information, which is required, but they might not go beyond that. And the problems that we encounter is if you don't treat a corporation like the separate entity that it is, the protections that you obtain from being a corporation may not necessarily exist anymore. So you can't do things like commingle your personal funds with corporate funds. You need to maintain the annual minutes and the books and memorialize any important meetings that happen with the directors or the shareholders, resolutions, etc. So those are things that need to be maintained on a regular basis so that the integrity of the corporation can be maintained and the shareholders can receive the benefits of continuing to operate a corporation. Some of the benefits of being a corporation are public image. It's important for some companies to have a certain public image of endurance. You know, when someone sees a corporation or an Inc. after a company's name, they feel like that company is going to be around or has been around or has some vested interest in the community or in the business that they are engaged in. So public image often is very important for companies. And sometimes they make that decision to incorporate just based off of that. Formalizing the entity, having a distinct and specific company is important often for the type of work that you may be engaged in. One of the main ones that obviously I deal with is liability protection. If you do not have a corporate entity of some type, whether it's a corporation or a limited liability company, by default in the state of California, you are either a sole proprietorship if you're on your own, or a general partnership if there's 2 or more of you. So what happens if you don't have a corporate entity is any actions or consequences that result within that company can be traced back to the owners. So for example, if there's a pizza place, and they're not incorporated, the owners own that as sole proprietorship, and there's an employee driver that unfortunately takes out a school bus on the way to deliver a pizza, the owners of that company could potentially be held personally liable for those actions. That's because the entity is essentially disregarded because it's not its own separate entity. So the liability flows directly through to the owners. So for certain high-risk companies, it's important to have that protection. In addition to having obviously really good insurance, you also want to have that layer of protection, because at that stage, in that scenario, if that pizzeria were incorporated, then the owners would not be personally liable. Sure, the company's assets may be at stake, but at least there is a distinction that can be drawn to where the owners won't be in fear of their personal assets having to be at issue, like their home and their personal bank accounts, etc. So the liability protection is key. And I work with many restaurants and bars. And so for those types of entities, it's really important to make sure that the corporate entity is in existence, it's very clearly operated, all the licensing is in place, all the insurance is in place, because those are generally high-risk endeavors. Expansion, it's much easier to expand in a corporation or a corporate entity than it may be without it. You can issue stock, and I don't know if someone has already spoken or will be speaking about stock options. Stock options can only be granted in a corporation. Corporation is the only entity that generally has stock. And there's a wide variety of different stock options that can be offered within a corporation, whether it's restricted stock, whether it's stock units, whether you're actually granting stock or employee stock options. There's a lot of opportunity for expanding within a corporation that doesn't exist in other entities or non-corporate entities. Funding. Sometimes, and this is generally obviously more important for nonprofits, but it can be important in private entities as well, because if you are going to be looking for any type of funding, governmental agencies often will require or look at your corporate status in order to grant those funds. They want to make sure that this isn't going into your pocket, that there's a specific corporation in place, an entity that's going to be receiving the funds, that they can allocate to, et cetera. So funding is important. And taxing. Once certain funds are going to be generated in terms of profits and revenues, after you reach a certain level, it's going to be to your benefit to incorporate. Why? Because there are greater tax advantages that you can benefit from in a corporation. There's different vehicles that are available to corporations that aren't available to sole proprietorships or LLCs. So those are kind of the main benefits of incorporating. Some of the costs, and these are just kind of the basic costs that you can expect. The state filing is $100 to file your articles of incorporation. The statement of information is $25 annually. To register with the Department of Corporations can range anywhere from $25 to $1,000 sometimes for some of our smaller ones, because it's based on the value of the securities that are being acquired. And generally in startups, you're not going to have a significant value to those initial capitalizations. Why? Because even funding your bank account with $1,000 is usually the way that you start. And then after that, you may start to acquire obviously additional capital, but at the outset, you're not going to necessarily have a whole lot going in.